Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Fly all the way to the moon with the best stock content on YouTube. Subscribe in style with Morris Money. Today, I'm talking about if you should buy Stag Stag Industrial. Investing in real estate can be a great way to generate passive income. Congress made investing in income-producing real estate accessible to all by creating real estate investment trust REITs in the 60s. Now, anyone can start generating income from this sector. Stag Industrial is an ideal REIT for income seekers. It pays a monthly dividend with an above-average current yield of 4.3%, much higher than the 1.7% dividend yield offered by an S&P 500 index fund. Here's a closer look at this great income-producing REIT. Stag Industrial owns industrial real estate, like warehouses and light manufacturing facilities. Robust demand is driving rental rates skyward as long-term leases expire. Stag signed 10.4 million square feet of new and renewable leases in the first quarter, addressing 78.2% of its available space for this year. Rental rates on these leases were now a staggering 30.6% above prior rates on the same space. The company isn't fully benefiting from the strong industrial market because it signs long-term leases with tenants. Those contracts have an average annual rental escalator above 2.5%. The company's same-store net operating income, accordingly, grew by only 6.9% in the first quarter. However, it has a lot of rental growth upside as existing leases expire and eventually roll over the market rates, which will likely keep rising. Stag Industrial's strong portfolio generates lots of stable rental income. The company pays less than 80% of that money to investors to support its dividend. That allows it to retain substantial cash, about $80 million annually, to finance new property investments. The industrial REIT also has a strong balance sheet. It ended the first quarter with a reasonable leverage ratio of 5, at the low end of its 5 to 5.5 target rate, $778.9 million of available liquidity, and minimal debt maturities for the next 2 years. That gives the company lots of financial flexibility to fund new investments. Stag will also recycle capital by selling properties to fund higher return investments. For example, it sold 2 buildings for $37.2 million in the first quarter. Meanwhile, the REIT closed one acquisition early in the second quarter for $26.7 million and had another building under contract. It's also investing $68 million to develop 2 new buildings it expects to complete in July. Stag has already seen strong interest from prospective tenants in leasing these buildings. Those deals are a small fraction of its current pipeline. Stag is evaluating 154 buildings representing $3 billion of investment potential. It won't close all of these deals, however, it has the financial flexibility to expand its portfolio as attractive opportunities emerge. Along with growth from rental increases, those future acquisitions and other investments will help grow Stag's cash flow, further supporting its monthly dividend. It should also allow the company to continue modestly increasing the payout each year. Stag Industrial owns a growing portfolio of in-demand industrial properties that's growing its rental income to support its attractive monthly dividend. It's a great option for those seeking to collect steady, passive income. As usual, before I close out these videos, I like to see what Wall Street has to say about this. Currently, 11 analysts are covering Stag, with 4 giving it a strong buy, 3 giving it a buy, 3 giving it a hold, and 1 person even giving it a sell. With the average price target at $36.95, this represents just over a 4% increase from this point. Let me know your thoughts about Stag Industrial down below, and let me know, do you own the stock, or are you looking to potentially buy the stock? Or like that one analyst, are you actually selling your position in Stag? Let me know your thoughts about Stag Industrial down below. Please don't take this video as financial advice, and thank you for watching Morris Money.